Order! Order! You are an incorrigible delinquent at times. Behave yourself, man!
It's been another bad day for the markets. The FTSE hit its lowest level since the summer of 2012. Around £100 billion has been wiped off the value of shares since the start of February. At the eye of the storm is Deutsche Bank. Its shares have slumped by 14% over the last 2 days, despite its attempts to reassure investors. A one-off or a canary in the coal mine for wider financial woes? Joining us now, our economics editor, Paul Mason. How do we make sense of this roller coaster?
Well, the markets carry on sliding. The FTSE down 1%. German and French stock markets down between 1 and 2 today. These are notable falls for any day, but when they keep carrying on day after day, it is a big problem. Athens down 3% in a day, 1/3 of its value wiped out since the start of the year. Now, what's clear is that people are cashing out of shares. Investors who hold shares are saying, where can I put my money that's safer? Let's try and put it into lending to governments, into government bonds. But we're going now, since the start of the year, sector by sector. We know that China's slowing. We know the rest of the global south, the developing world, will slow. So people cash out of commodities, mining, some foodstuffs. And now it's the turn of banks, because everybody's now worried about, is there a bank or some banks that are more exposed than others? And it is, as you mentioned, Deutsche Bank, based in Frankfurt, that everybody's now focused on. Don't panic. The stock market's not actually dead. These German traders are in costume for carnival time. But the DAX, the Frankfurt Stock Exchange, is not in carnival mood. Shares in Deutsche Bank, its biggest bank, fell 5% today, 40% since the year began. This graph shows what it costs investors to insure against Deutsche defaulting on its debts. It's spiked to levels not seen since the euro crisis of 2011. Deutsche last night said it has the money to pay bondholders despite making a near £7 billion loss last year, but the problems facing all European banks are real.
The biggest driver of that trend we saw yesterday was essentially the ability of banks to stay profitable in this low interest rate environment, low growth, and especially if that continues to stay for longer periods of time, which the market is increasingly pricing in. So when you then look at a company like a Deutsche Bank, it essentially shows you that the market is waking up to that reality.
In the City of London too, it's reality time. The FTSE 100 fell to its lowest mark since 2012 today. Faced with the slowing world economy, investors are pulling money out of everything risky. Mining companies, now banks, and there are worries too about some of the so-called unicorns, high-tech companies like LinkedIn, whose shares fell 43% last week.
But Paul, these are just stock market moves. Do they really affect the real economy?
I mean, those of us who remember the distant past of the late 2000s, like 2007-8, will remember that that's what politicians used to say, look, markets are wobbling, but the real economy is okay. We have to remember that markets are the financial community's best guess at what is going to happen later. So we need to be worried about the slowdown, but it is only a slowdown in growth at the moment. The real concern for investors strategically is low inflation leading to flat inflation, leading to negative prices, even for the safest money on earth, which is lending to governments.
Paul Mason, thank you.
And fears are growing about the health of the global banking industry again. Simon Jack is here. Simon?
Thanks, Sarah. Yes, shares in some of the world's biggest banks have collapsed in recent weeks. Some are down 40% or more. One of the worst hit is Germany's biggest bank, Deutsche Bank. The chief executive, John Cryan, was moved to send a letter to its 100,000 staff members yesterday, reassuring them the German bank's balance sheet was rock solid, as he put it. But markets just don't agree. So who's right? Are we headed for another crisis? Peter Hahn is Senior Fellow in Banking at Cass Business School. Morning, Peter.
Morning.
Now, Deutsche Bank is trading at about 40% of the value that on paper it's worth. What's the problem?
People don't see growth. They don't see return on the assets. I wouldn't argue too much with his asset comment as much as it's really about the profitability of the banking sector right now, and we've accepted that it's not going to be that profitable.
One of the other things that investors are worried about is that some of these bonds, that when you lend to banks, they're sort of bail-in. So if the bank gets into trouble, in the old days, you knew that the government was going to bail you out. You could argue that might still happen. But now these investors will be forced to turn their debts into shares, and a lot of investors saying, I don't actually fancy doing that.
Yes, well, it's just a few big points. I think quickly, we didn't always know that banks were going to get bailed out, and that's actually what we did see last time, and that changed investors' perceptions of the risks. So banks were able to sell, and recently have sold, two types of bonds. There's one type, which we would recognize as the normal kind of bond, normally called senior notes in the case of banks. But there's another type called contingent convertible bonds, which are really equity dressed up as bonds. And I would say they've been totally mispriced for a number of years, and regulators throughout the world have thought that and perceived that investors were really taking equity risk and pricing it like debt.
Now, it might sound comical, but it's vital to the future of Britain's banks. CoCos are a new kind of financial product, a way for banks to make themselves stronger in any future crisis. The banks and regulators are enthusiastic, but many senior figures in the city think there's a risk that CoCos simply won't prevent a rerun of the 2008 crisis. Now, the chair of the Treasury Select Committee has told Channel 4 News the Bank of England needs to investigate them. CNBC's UK business editor, Hilia Ibrahimi, has this exclusive report.
Wouldn't it be great if the next time there was a global financial crisis, banks could call up extra capital as if by magic?
That's great. This one goes on my left, this one goes on my right. If I squeeze this one hard enough, it should go from here and then jumps over here. So one here, one here. One goes in my hand, one in my pocket and one in my hand. So how many have you got inside my hand?
Two.
So there's three, one's gone red.
Since the economic meltdown of 5 years ago, regulators themselves have been working on their own bag of tricks to fix the industry. The problem with magic is that it's not always what it seems. What if the very innovation designed to help protect the taxpayer from another bailout instead turns out to be another illusion? What if the very thing designed to make banks safer turns out to make it worse? These innovations, known as CoCos, are already one of the most fashionable trades in the city with hedge funds and bankers. And that's despite the fact that some have nicknamed them death spiral securities. So how are CoCos, or contingent convertible capital, meant to help the banks? Banks hold reserves of capital. This can be set against losses they make on loans as they build up. The more capital they have, the safer the banks are. CoCos start life as bonds, but in a crisis, CoCos become available as capital, which helps lenders absorb losses. Critics think that when this happens, there could be a problem. When Lehman Brothers collapsed in 2008, it became dramatically clear that the foundations of some banks were terribly shaky. Some collapsed altogether, bringing the global economy to its knees. Britain suffered its longest depression in over 100 years, costing millions their jobs and sparking the tightest squeeze on household finances in generations. If such a crisis were ever repeated in the future, CoCos should spring into action to act as an emergency buffer for the banks. But shareholders and critics worry that the minute CoCos are triggered, they give a signal to the market that the bank is in trouble. And quickly there's a run on the bank similar to the one that brought down Northern Rock. A leading voice in the city, Jessica Ground from Schroders, one of the world's biggest investors, told me that CoCos could fail to offer enough protection if we had another financial crisis.
The risk is that investors forget that these aren't traditional bond-like investments. They think of them as being very safe. When you have systematic problems, regulators will get concerned about the signal of saying all of these banks have got to convert, all of these banks have got capital problems. They're not going to want to cause a run on banks and a drying up of liquidity, which was the real problem. They want to make sure that people remain confident, and I think they'll be concerned about the idea of not triggering these CoCos to maintain confidence if there is a widespread crisis.
A lot of people love CoCos, even the regulators. But critics warn that the Bank of England may be failing to take into account unpredictable market behaviour. Instead of assuring the marketplace, that whole death spiral effect could mean CoCo's spark panic instead. A classic case, perhaps, of unintended consequences.
Anyone you like.
Some shareholders may be sceptical, but the trade in CoCos is doubling in size every year, making a lot of people rich along the way. Most UK banks have now issued them, including Barclays, and just this week, Lloyds closed a £5 billion CoCo deal.
There's no thread here, that's going entirely by itself.
CoCos seem incredibly popular. Investment banks are trading them, hedge funds are buying them, even pension funds and insurance businesses are buying them now. Why are they so popular?
I think the primary reason is that interest rates are so low. So the returns that you're getting on very safe assets like government bonds aren't that attractive to a lot of investors. They want more income, and so they're looking up the risk curve for different types of assets.
Because the issue is important to taxpayers, senior politicians also want answers.
Most people have concluded that CoCos have something to offer in strengthening bank balance sheets and making them more resilient in a crisis. But there's always the risk that the structure of some CoCos could have the opposite effect. And that should be looked at carefully by the Financial Policy Committee of the Bank of England. That's what we've got them for. They're a relatively new body put in to do exactly this kind of work, to identify what can help make our banks safer and what will make them riskier.
These are my cards, they're all different.
There were warnings again this week that taxpayers could be on the hook for banks being rescued, making it clear that there is still work to be done before the system is totally fixed.
And make sure you're happy with it, that's important.
If we are to avoid the mistakes of the past, we have to make sure that we're not just conjuring up magic.
Like, what people want to know is, are we on the cusp of another 2008 type event?
Well, I think we're seeing similar pricing changes, that we see who's the next target bank, whose securities are going to pop down.
OK, that's the banking view. What's the investor view? Anne Richards is the Chief Investment Officer at Aberdeen Asset Management. What do you make of all this?
Well, the first thing to say is that markets are never comforted when politicians and bank management rush out to say that everything's absolutely fine.
It's a bit like the board backing a football manager.
Correct. You know that the next week he's going to be up there with his resignation letter. So there's a little bit of a sense of that. And I think there's a couple of different things to tease out of it, though. The first is that post-crisis, there's been a huge amount of work put into recapitalising the banking sector and the financial sector. And we've had all these series of stress tests which suggests that we should have more confidence in the amount of capital, the amount of liquidity that is in the sector as a whole, which is good ballast. But one of the unintended consequences of a lot of the regulatory change that we've seen over the last few years, it's made the plumbing that sits underneath all of the financial system, it's effectively squeezed the pipes. The pipes are narrower than they were before. And if you just think about what that means at home, when you've got a narrower pipe, it's much more liable to be
Just explain
blocked.
what you mean. What's that? I'm not quite getting that enough.
So in terms of the plumbing, this is when banks lend to each other, when individual investors or funds put up collateral, when you go in and you buy protection against default in the CDS market, for example, there's banks have less ability to act as intermediaries and smooth the flow between a buyer and a seller in all of these different areas. And as a result of that, it just takes a tiny little dislocation or some lack of confidence coming in those counterparties to kind of spread.
So it's a lack of liquidity, basically.
It's not precisely liquidity. It's a lack of ability to put capital up to smooth any imbalance between buyers and sellers in a whole host of different markets, which are quite technical, which sit underneath this banking system.
Peter,
well, if I come back, I think the intention of regulators was to increase capitalization at banks. But what happened was they gave in to this concept of allowing this type of bond to be used as capital. So instead of raising the amount of equity that we really wanted banks to do, many banks sold these contingent capital bonds. And again, it was great, tax deductible, lower cost, but now that's sort of coming through in an unfortunate way.
Well, people obviously very nervy out there in the market at the moment. Let's hear the thoughts of Adair Turner. Now, remember, he was the head of the Financial Services Authority in the teeth of the last crisis, and this is what he had to say.
We should not exclude entirely the possibility that public money might be required to recapitalise banks in extremis.
So when people say never again, we don't mean that.
I think the never again is complete nonsense and very dangerous.
Peter Hahn, the public will still be on the hook if the banks go down.
Of course. No, and government should be. We remember that the UK didn't invest in Royal Bank of Scotland. It basically kept the cash coming out of the cash machines and kept the economy going. And we're never going to be that stupid to say if it's necessary, we have to do that.